If you move to Dubai but don't exit the Canada's tax system properly, the CRA can still tax you, even years after you have left. And in this video, I'll explain to you how to become a non-resident in Canada the right way and what steps you need to take to avoid tax surprises from CRA down the line. In Canada, the personal taxes can go over 50%. In Dubai, there is no personal income tax at all. And I'll show you how the CRA tests residency, what ties you need to break, and how to build a clean tax setup in Dubai from day one. Before we start, my name is Shiraz Wahid, and I've helped hundreds of entrepreneurs move to Dubai, relocate their businesses and families, and also reduce their taxes legally, many of whom actually came from Canada. So if you want my help in doing the same, you can book a strategy call with me at setupHero.com/call. Canada taxes you based on your residency and not your citizenship. That means if you are a Canadian citizen but no longer a resident for tax purposes, you don't have to pay Canadian income tax on your worldwide income. The CRA use a set of rules to decide if you have become a non-resident. These rules focus on whether you have truly left Canada and established a new life elsewhere or not. The CRA look at two types of ties: primary ties and secondary ties. Primary ties include your home, your spouse or common law partner, and your dependents. If you still have a house in Canada that you can use, or your spouse and kids live there, the CRA will probably consider you a tax resident. To become a non-tax resident, you usually need to sell or rent out your home, or if you're already renting a home from someone else, you need to cancel your lease and move your immediate family with you. Secondary ties include things like the Canadian driving license, bank accounts, health insurance, memberships, and personal property. The more of these ties that you keep, the harder it is to prove that you have truly left Canada. And if you cancel these and establish similar ties in Dubai, like getting a UAE residency, local bank accounts, and leasing a home in Dubai, you strengthen your non-resident case. The CRA also considers how long and how often you return to Canada. If you spend a lot of time there each year, it can work against you. But if your visits are shorter and infrequent, it supports your position that Canada is no longer your main home. To officially notify the CRA, you file a form called NR73. This form asks about your move, your ties to Canada and Dubai, and your plans for the future. The CRA then reviews your situation and gives you an opinion on your residency. You don't have to file this form, but it can be helpful if you want clarity. If you choose not to file it, the CRA will judge your residency based on your tax return and any audit that they might perform later. Once CRA accepts you as a non-resident, you no longer pay Canadian taxes on your worldwide income. That includes your salary, your business profits, dividends, and capital gains. You will only be taxed in Canada on certain Canadian-sourced income, like rental income from a Canadian property or dividends from Canadian companies. In those cases, a withholding tax may apply, usually at 25%, unless reduced by a tax treaty. And before you leave Canada, you may have to pay something called a departure tax or exit tax. This applies if you own certain investments or property when you become a non-resident. The CRA treats it as if you have sold those assets the day before you left, even if you didn't actually sell them. This can create a capital gain tax bill. Common assets affected by departure tax includes share in companies, ETFs, and rental properties. Your principal home is usually exempt. You report this on your final Canadian tax returns, and either you pay the tax or provide security to the CRA if you want to defer this tax payment. Some people sell or gift assets before leaving to simplify the process. Others restructure their finances in advance to reduce the tax burden. Planning ahead is important because once you leave, fixing mistakes become much harder. Now let's talk about Dubai. In Dubai, there is no personal income tax and there's no tax on salary, business profits, capital gains, dividends, or inheritance. If you qualify for Dubai tax residency and you have become a non-tax resident of Canada, your income can be completely tax-free. But the key is doing both parts correctly. You must become a non-tax resident of Canada and a tax resident of Dubai. And to become a Dubai tax resident, you need a valid residency visa to spend enough time in the country. There is no official day count rule like in some countries, but generally spending at least 3 to 6 months per year in Dubai is considered safe, depending on your personal situation. You should also always have a rental contract, local bank accounts in Dubai, and ideally a company and a job here. These will help prove that Dubai is your main home indeed. The CRA may also ask for proof of your new residency if they audit. So keep good records that include your Dubai visa, your Emirates ID, utility bills, lease agreements, flight tickets, or any proof that you have ended your Canadian ties. And if you apply for a Dubai tax residency certificate, it adds even more strength to your case. And if you still own a business in Canada or earn money from Canadian clients, you need to be careful. If the CRA believes your business is still managed from Canada, they may tax the income. To avoid this, you must shift control and operations to Dubai. That includes having your main office here in Dubai, using UAE bank accounts, and showing that you are making key decisions from Dubai. Some Canadians try to keep things quiet and just stop filing tax returns. Well, this is risky. If the CRA finds out, they can reassess you, apply penalties, and charge interest. It's better to exit properly, file your final tax return, and document everything. That way, you can move forward with a peace of mind. If you're planning to reduce your taxes and build a new life in Dubai, you need a proper structure. That means setting up a UAE company, getting your residency, opening local bank accounts, and planning your exit from Canada. Each step has its rules, and doing it the right way saves you from headaches later on. So, if you want my help in setting up your Dubai company, residency, banking, and exiting the Canadian tax system, you can book a strategy call with me at setuphero.com/call. We'll go through your situation and build a clear action plan that works for you. And if you're serious about using Dubai to reduce your taxes and grow your business, you should really check out my next video right here.